That's actually a very useful cycle I found, and I know many traders that I've worked with who've used that cycle.
Welcome to the Think Profit Podcast. All information in this podcast is for educational purposes only and is not financial or health advice.
Hey, Walter, let's talk about the what you call the cycle of doom, or what I call the trading silodrome. What is that, and why is it a bad thing?
Oh, okay. So cycle of doom is I wrote about in the Naked Forks book. It's just you find a new strategy, you trade it for a while, or you find a new strategy, get excited, trade it for a while, hit a losing streak, draw down, give up, and then either throw it completely away and find something new, get really excited about it, or you tweak it so that it's not really the same strategy, right? And so you
hmm
keep doing that. And I actually believe that cycle is really useful if you are if you're trading a strategy you like and then you find it doesn't work very well, like in your back testing. And then the tweaking part is when you usually like will tweak the exit. That's actually a very useful cycle I found. And I know many traders that I've worked with who've used that cycle of back testing, back testing, back testing, and then they go, it's not quite good enough. They change the exit, back test again, change the exit, and then finally they nail it, and then they're happy, right? And they move on to the next one. And a lot of the work that we do with traders is basically first ensuring that they're trading the right system for them and ensuring that it has an edge. And then once you do that, it's all about the exit. So yeah, so I don't necessarily think it's a bad thing. I think it's difficult because the way that trading is sold to people is that your indicators are the solution. And the issue with that I have is that when you trade, if I trade a system with the alligator indicator or whatever, right? Bill Williams alligator, let's say, and then the moving average or whatever, or let's say I use stochastics and the alligator. Okay, fine. Now what happens is I trade it for a while, I get a drawdown, I blame it on the indicators or the blame it on the system, and I throw it away, and I'll never look at the alligator again. I'll never look at the stochastic again, or I don't have to because I say, look, this isn't work. And so I've thrown it away. And now I move on to the ADX and the RSI. Okay, right. And so
hmm
this is the issue is that you never really get comfortable looking at the charts from one point of view because you're always throwing away your template. You're throwing away your glasses, the way that you see the markets. And so that's why I encourage people to try and adopt, if they can, naked systems, because naked systems encourage you to learn price action. And once you learn price action, you will always see it. You would have to move, well, even if you move to a line chart, you're still going to see some things. So it's really hard to get away from candlestick interpretation unless you completely delete the candlestick charts, which I guess is possible. But it's just, to me, it's very useful approach because the I believe the indicator approach, which is, in many ways encouraged and subsidized by the guru culture in trading. They're all selling the perfect strategy for you. I think it's just so easy to get excited, use it for a while, throw it away, and then go find something else. So that's why I think the cycle of doom can be detrimental to your learning curve, not because tweaking things is a bad idea. In fact, I think tweaking exits is a great idea in your backtesting phase. It's just that you never really lock into one approach or one view of the markets, and that you're always a beginner. You're always a newbie. You never really get that experience that you would get if you just sit and watch candlesticks for 25 years. So that's
hmm
my what is your what did you call it? The cycle, the
Trading
silo.
silodrome.
Okay,
It's
what
like
is
when
that?
it's that carnival attraction where the guy on the motorcycle rides around the inside of the
Oh,
tube.
yeah, yeah. Yeah.
And that's kind of like how traders are, right? You just go around and you keep switching systems. And I think that's the important thing. I think a lot of traders don't, number one, find something that makes sense to them. So if the RSI makes sense to you, then great. But I think you need to, like you said, keep on iterating on that until you've exhausted everything and realize, okay, this doesn't work for me. Maybe it works for other people, but it doesn't work for me. So I'll move on to the next thing, which could be price action or the ADX or whatever it is. But I think that's one of the issues. They just jump to a totally different thing, thinking that's going to be the pot of gold. And it just doesn't work like that, because you need to spend some time with it. You need to uh, you know learn the nuances and learn what really makes it tick and what people are using it for. I think that's a really important thing. They think that they can learn a strategy straight from a guru and then use it as is, and that's it. But in reality, like with a lot of things, you have to do your own research and put these pieces together of different things that people are doing. And I think that just people don't spend enough time doing that.
Yeah. So true. So true. It just has to be instantly right,
Yeah, yeah, yeah. So what do you think about volume? Have you looked into volume at all in terms of like price action trading?
I have. I find it a little bit difficult in currencies and cryptos, which are the main cryptocurrencies and currencies, which are the main ones that I trade. Like those markets, it's a little bit hard to know exactly if you've got it because ultimately you have to choose a broker. Like in either
Hmm.
case, there's no centralized
Yeah.
location, and so you have to choose a broker, and you have to assume that your broker is giving you a pretty good picture of what's going on. So I think you could probably make that assumption. I've tried different volume things. It doesn't work very well for me. Maybe I just have the wrong, combination, or I'm just not motivated. I also know, like, I know traders that use candle size as a proxy for volume. That
Mm,
makes a lot of sense too.
sure.
So yeah, I don't. It's tricky. I mean, like just the other day, I was using a chart to look at a trade, and then when I pulled up the platform to take the trade, it was on Litecoin against the USD.
Mm,
It was a completely different price. Like
mm,
it was like, you know what I mean? And that like really drove home the point. Like I was doing my analysis here where it was at like 90, I think 96.12 or something, $96.12. And then when I looked on my platform, it wasn't the spread either. It wasn't that the platform had a wide spread. It was just that it was all the way up at 96.55. I'm like, wow, that's almost a half a dollar, 50 cents nearly that it was the difference. And so, I was like, that those are the sorts of things you have to deal with when you're in these parallel markets. So I guess that's why I'm a little bit leery of volume. I think it can definitely work. I just think you need to be really good at like, there are scalpers that use it. Um, there are definite approaches for it, but you just have to be, uh, careful, I guess, in where you get your data from, I suppose. Yeah,
mm. Yeah, that makes sense.
yeah,
Yeah, I could see that in the crypto market because I know that the volumes and the prices are way different. Forex is a little bit
yeah,
closer, but in crypto, it's like
yeah.
just depends on which exchange you're on, right?
Yeah, but that's great because that's arbitrage
Mm,
opportunities for people who are interested in that. A lot of the super algo automated dudes, I think that's mostly what they do. Like one guy was saying that he had like 12,000 trades and he never had a loser. And I'm like, okay,
mm.
this guy's doing arbitrage.
Yeah,
You know what I
yeah,
mean? Like
yeah.
that's you know what I mean? I mean, it sounds very impressive. And it is, but it's probably that's what's going on. I knew 12-year-old kids that were doing arbitrage in with Bitcoin, but that was 12, 11 years ago or whatever, 12 years ago. So yeah,
Mm,
so it's different, but it's definitely still possible, especially with some of the problem is going to be with arbitrage is does the spread eat up your profits?
mhm.
I can or if you trade too much volume, then it corrects, like you self-correct them. Like you are,
Yeah,
do you know what I mean? Like
you're the market
that's the
basically.
yeah, you're in the market. Yeah, that's the
Yeah.
ironic thing about arbitrage is that you end up fixing the market by doing arbitrage. You get the prices to where they should be. So so that's why it's a really cool thing in like new markets.
Mhm,
Everyone is drawn to arbitrage in new markets because that's when it has the fattest profit. Then later on the mature markets, it kind of just goes away. Um, and then you have to wait for another shift. Like right now in gold, I think there isn't a gold market in China or something, and like their price is way different to what you'll get in the U.S.
oh,
So there
okay.
are arbitrage opportunities right now, starting right now with these new gold markets. I think maybe India is going through the Chinese market now or whatever. It's all so there's like people are saying, wait a minute, why is the price in the US and London over here, but in China it's way up here? Like what's going on
Yeah,
here? So that will fix itself. Like you can guarantee that the arbitrage people are gonna jump in on that for sure.
Sure.
Yeah.
Sure.
Yeah.
Okay, cool. Thanks, Walter.
Thank you.